All right, welcome everyone. Thank you so much for being here. We're gathered today for a crucial briefing, really, to break down a fundamental shift that's happening in our global financial order, a change that is already defining the entire investment landscape for 2026 and certainly for the years to come.
And it all really boils down to this one question. Why now? Why do these massive super cycles in metals seem to ignite right when our confidence in the monetary system starts to crack? You see, this isn't just about a price going up. This is about a full-blown regime change. It's about trust, it's about value, and really, the very nature of money itself. And the answer? Well, it's unfolding right in front of our eyes.
So back in January, this was the shot heard around the financial world. When gold breached $5,000 an ounce, it wasn't just another new high. No way. It was a signal, a massive flashing red light indicating a structural repricing of the entire global monetary system. Okay, so let's really dig into this. That $5,000 price tag. You have to understand that's the symptom, not the cause. It's the result of a really deep crisis of confidence, and it's being driven by three distinct but totally interconnected fractures in the very bedrock of our financial system.
So, first up, geopolitics. You know, the very public threats of slapping huge tariffs on traditional allies. Think Canada, France, over disputes about Greenland and NATO. That just shattered the illusion that there's this stable, unified economic front. When the country that issues the world's reserve currency starts using trade as a weapon against its own friends, global capital has to find a new home. It has to look for an apolitical, a neutral store value.
The second fracture is institutional. And frankly, the market perception that the Federal Reserve's independence is basically over, that's a monetary Rubicon we've crossed. I mean, the Fed has always been seen as the wall preventing the government from just printing money to pay its bills. If that wall comes down, the market has no choice but to price in a future where QE isn't an emergency tool anymore, it's just permanent policy.
And as Peter Schiff puts it so bluntly, this is it. This is the end of the Fed's credibility. It forces the central bank into a corner where it has to keep yields down on a national debt that's just ballooning out of control, unleashing inflation that, our traditional policy tools just can't handle.
And that leads us right to the third fracture, which is just simple, brutal math. With U.S. national debt now screaming past $38 trillion, the market is waking up and realizing this path is completely unsustainable. You see, gold has totally decoupled from its old relationship with real yields, and that's a huge tell. It means sophisticated investors are no longer focused on the return on their capital. They're terrified about the return of their capital.
And this just perfectly illustrates the consequence. As Ray Dalio observes, what we're witnessing here is a complete breakdown of trust. The world's creditors are just no longer willing to blindly fund the issuers. He calls it a capital war, and in that war, gold is the ultimate safe harbor.
Now look, this isn't just some abstract theory. The smart money is responding. The most powerful financial players on the planet, we're talking the central banks themselves, they aren't just listening to these signals, they are acting, and they are acting decisively. Now take a look at this. What's absolutely fascinating here is just the sheer speed of this pivot. Ever since the dollar was so overtly weaponized back in 2022, central banks have been stacking gold at record levels. And the projections for 2026, they show them buying at a rate 4 times higher than their historical average. They aren't guessing. They are preparing for what comes next.
And what's really validating is that this regime shift isn't some fringe idea. There's a clear consensus building among some of the sharpest minds in our industry. Their views, they kind of complement each other, creating this powerful intellectual framework, what I call the 4 pillars supporting this new reality for gold.
So first you have Rick Rule. He frames this perfectly. He says this isn't a gold bubble. It's a rational repricing of the denominator, the currency itself. He sees the dollar's value just getting eroded by this unchecked expansion of the money supply. Simple as that. Then Peter Schiff comes in with an even starker prediction. He's forecasting a collapse in the dollar index, all the way down to levels we haven't seen since 2008. And he argues that gold's breakout isn't temporary. It has established a permanent new floor for its value for the rest of our lifetimes. And Ray Dalio, he brings us right back to the motive of those central banks we just looked at. He says it's not about speculation, it's about fear. It's a strategic move by entire nations to get away from an asset that can be sanctioned and an issuer that can devalue their holdings at will. And finally, Matthew Piepenburg gives us this powerful analogy. He says, paper money is like a beautiful ice cube. but it slowly melts if it's abused. This crazy exponential move we're seeing in gold, he says that's not something to celebrate. It's an alarm bell. It's a peak warning that the whole underlying system of fiat currency, of paper promises, is fundamentally broken.
So, the crucial point for all of us is to understand what this new era demands from investors. This isn't just another cyclical change, it's a structural one. It's heralding the return of real assets and, you guessed it, the dawn of a new metals supercycle.
So what even is a metal supercycle? Well, it's not a short-term rally. It's a fundamental regime shift where the market's entire perception of value changes. It happens when all those financial promises start to feel fragile, and suddenly the tangible scarcity of real stuff, that really starts to matter again.
And this slide, I think, just brilliantly illustrates that transition. We're moving from a world where we believe the dollar guaranteed stability to a new world where real assets are what guarantee resilience. And listen, the dollar doesn't need to completely collapse for this to be true. It just needs to share the stage.
So what does this all mean for your strategy? It means gold is no longer optional insurance. It's essential ballast for your portfolio. It means that preserving your capital is now way more important than chasing returns. And it means in a world riddled with policy errors and systemic risk, holding real, physical assets is no longer a tactic, it's a strategic necessity.
And so this is the question I'll leave all of you with. As we navigate a system where financial obligations can literally be created out of thin air, we all have to ask ourselves a very simple question. What is the true enduring value of something that cannot be printed? Thank you.